Hello dear students, in this particular session we are going to deal with paper 6 FM and we are dealing with RTP for May 2024 attempt, right? So the RTP that is given by the institute is first of all having division A, and they have created a case study scenario over here. Now this case study is related to the chapter called as the chapter called as working capital. Not only the working capital, the chapter is also having some details about the receivables management. So there is a comprehensive question which has been created by by the institute, and this question has been has been converted into MCQ format. That means the questions which are asked are in are in MCQ format. So the entire question is given to us and they have created 5 MCQs out of it. So that is your division number, division number A. The second division is descriptive questions, which is nothing but the questions that we are solving in the classroom. So from that we are having a question related to ratio analysis. We are having question related to cost of capital as well. We are also having the question which is related to capital structure. Here this is capital structure theory question. Then there is leverage question. Then we are also having investment decisions, which is your capital budgeting. Then we are having one question from from dividend decision, and again we are having one very good and a comprehensive question from from working capital. And the last question is a theoretical question. So these are the these are the 8 questions from the second section, that is section number B. So in this particular session, students, we are going to start with the with the analysis of this particular RTP. So I'm going to deal with the first question now, which is related to working capital as well as receivables management and all that. Okay. So let us start with with the first question. Now, Armour LLP is a newly established startup. So the first information that is given to you is that it is a newly established established startup. Now, dear students, you already know that if it is a newly established startup, that means there are no opening stocks in this particular organization. That means there will be no opening stock of raw material, there will be no opening stock of work in process, there will be no opening stock of stock of finished goods. So they are dealing in a manufacture of a revolutionary product, and the name of the product is given to us, which is a substitute to to the conventional wood and plywood. Now, it is an economical substitute for the manufacture of the furniture and home furnishing. It has been asked by a venture capitalist for an estimated amount of funds required for setting up the plant and also the amount of circulating capital required. So, dear students, this circulating capital is nothing but it is the amount of the working capital that is required. So, we are supposed to calculate, maybe we are supposed to calculate the amount of working capital that will be required for this particular newly set up startup. Okay. Now, a consultant hired by the entity has advised that the cost of setting up the plant would be 5 crore rupees. So this becomes the cost of the cost of the plant, and it will require 1 year to make the plant operational. The anticipated revenue and the associated cost numbers are as follows. So dear students, we are given that there is some anticipated revenue and also the cost information has been given to us. So let us see what is this particular anticipated revenue and the information of the cost. First point that is given to us is about the units to be sold. Here, the units manufactured are not given to us. The units which are sold is given to us. And here the units which are sold is 3 lakh square meters per annum. So dear students, this particular square meters, we are going to read this as as our units. So how many units are going to be sold in the first year of the operations? So 3 lakh units are going to be sold in the first year of the operations. Then we are having selling price of each square meter, means selling price of each unit, that is 1000 rupees. Then we are having raw material cost, which is 200 per unit, that is per square meter. Labor cost is 50 per hour. And the labor hour per unit is is 3 rupees. So dear students, if I convert this labor cost into units, then it will come to what? It will come to 50 per hour into how many hours? Into 3 hours. So it is going to be 150 per per unit. Okay. So I converted the labor cost into into per unit cost. Then we are having cash manufacturing overheads, which is 75 per machine hour. And we are given that the machine hour per unit is 2 hours. So dear students, if I convert this particular cash manufacturing overheads into per unit, so it is also going to be 75 into 2 hours, which is going to come to 150 per unit. So dear students, the labor cost I have converted that into per unit, and the cash manufacturing overheads also I have converted this into per unit. Now let us read the question further. We are having selling and credit administration overheads as rupees 250 per unit. Now, being a new product in the industry, the firm will have to give a longer credit period of 3 months to its customer. So, what is this particular 3 months? So, this is going to be your debtors, debtors collection period. So, the debtors collection period is 3 months. It will maintain a stock of raw material equal to 15% of the annual consumption. So, here the stock of raw material holding period is not given to us. They are telling that the stock of raw material is going to be 15% of the annual consumption. That means it is going to be 15% of the RMC, that is raw material consumed. Now, based on the negotiations with the creditors, the payment period has been agreed to be 1 month from the date of date of purchase. So, this particular 1 month is nothing but it is your creditors payment period. Then we are given that all the other expenses are to be paid 1 month in arrear. So all the other expenses means all the cash expenses are going to be paid 1 month in arrear. So this is nothing, dear students, but this is your outstanding outstanding period that has been given to us. So this will help us to find out find out the current liabilities. Now cash and bank balance to the tune of 25 lakhs is required to be maintained. Then we are given the entity is also considering reducing the working capital requirement by either of the two options. Option number A, that is option number 1, is by reducing the credit period to the customer by a month, which will lead to reduction in sales by sales by 5%. Second option is by engaging with a factor for managing the receivables, who will charge a commission of 2% on the invoice value and will also advance 65% of the receivables at the rate of 12% per annum. Now, this will lead to the savings in the administration and bad debts cost to the extent of rupees 20 lakhs and 16 lakhs respectively. So, dear students, this is about the reduction in reduction in working capital requirement. So, here they have connected this particular working capital with with the receivables management, and they have also introduced introduced the factoring option over here. Then, the entity is also considering funding a part of the working capital by bank loan. For this purpose, bank has stipulated that it will grant 75% of the net current assets as advance against the working capital. The bank has quoted 16.5% rate of interest with a condition of opening a current account with it, which will require 10% of the loan amount to be the minimum average balance, right? So we will deal with this with these two paragraphs at the end of the end of the questions. Now, what are the questions? Let us go through. You being a finance manager has been asked the following questions. The first one is anticipated profit before tax per annum after the plant is operational, right? So we have to first find out find out the profit. So for that we will have to prepare the prepare the cost structure. Second is the estimated current assets required in the first year of operations, and debtors are to be valued at at cost. That means they are asking you to calculate the gross working capital, which is nothing but the total of the current assets. Also, third one is the net working capital requirement for the first year of operations, right? So these three are related to your working capital. Then the fourth one is the annualized percentage cost of two options for reducing the working capital. And the last one is what will be the maximum permissible bank finance by the bank. And the last one is what will be the maximum permissible bank finance by the bank and the annualized percentage cost of the same. So the last two is about the last two paragraphs in the in the question. So first we will start with our understanding of understanding of calculating the working capital. Okay. So dear students, as you can see, what has been given to us over here is that we are not given the number of units manufactured, but we are given the units to be units to be sold. So how many units are to be sold? So 3 lakh units are going to be sold. Now let us see that if there is any finished goods information that has been given to us in the question. So this particular paragraph here, they are telling that the entity will hold the finished goods equal to 2 months of the units to be to be sold. That means whatever units are sold, out of that, the units equivalent to 2 months are going to be kept in kept in the finished goods. So students, it is understood that the number of units manufactured will be more than the number of units, number of units which are sold. So first I will be calculating the number of units which are which are manufactured. So this is about about our descriptive section number A. In that I am dealing with the with the first question. So our first working, dear students, will be number of units manufactured. So dear students, we understand that the number of units manufactured is going to be the number of units sold plus the closing stock of of the finished goods. So the number of units sold is already given to us in the question. So the number of units sold is 3 lakhs. Plus here they are telling that the finished goods is going to be of equivalent to 2 months. So 3 lakhs is the units which is sold for the entire year. So the stock equivalent to 2 months, we do the do the multiplication and we find out. So this will come to 3 lakhs plus this will be 50,000. So dear students, the number of units manufactured are 3 lakhs and 50,000. So now we will have to we'll have to find out the working capital where 3,50,000 units are manufactured and 3 lakh units are 3 lakh units are sold. Okay, now students, we will be calculating the information of the cost per unit and the profit per unit, so that it becomes easy for us to do the calculation of the calculation of the other things. Okay, so let us see what are the cost details over here. So let us start with the cost information. The raw material cost is 200 per unit. So first I am writing here. All this is in per unit. So raw materials are 200. Then second is is the labor cost, and labor cost is 150 rupees. Then the third cost is is the cash manufacturing overheads. Cash manufacturing overhead is also 150. Then dear students, we are having the we are having selling and then we are having credit and then we are having selling and credit administration overheads. This, dear students, is 250 rupees per unit. So if I calculate the total cost over here, so dear students, the total cost over here will come to 750 rupees per unit. It will come to 750 per unit. Then we are having the selling price per unit as how much as 1000. So dear students, the profit per unit will be 250, which is nothing but 1000 selling price minus 750 of 750 of the cost, right? So this is the information of of the profit per unit, total cost per unit, and the selling price per unit. Now we will calculate the calculate our cost structure, which is going to be for 3,50,000 units manufactured and and 3 lakh units which are sold. So let us do the working of cost structure for 3,50,000 units manufactured and 3 lakh units sold. So we'll have particulars, calculations and amount. First, I'll start with RMC, that is raw material consumed. So this will be for 3,50,000 units, and raw material consumption per unit is 200. So this will come to 7 lakhs. Sorry, 7 crores. Then the second information will be labor. Now labor is 3,50,000 into per unit we have already calculated, which is 150. Okay, dear students, so the labor cost is 3,50,000 and it is 3,50,000 into 150 per unit we have already calculated. So 3,50,000 into 150, this will give you 5 crores and 25 lakhs. Then the next cost is going to be cash manufacturing overheads. Cash manufacturing overheads will also be for 3,50,000 units into 150 per unit is already converted. So this will also give you the same result. So now we are having RMC, that is raw material consumed, labor and cash manufacturing overheads. When you take the total of this is going to give you your cost of cost of production. So this will come to 17 crores 50 lakhs. Now dear students, to this cost of production, normally we first add opening stock of finished goods, which is not there because it is a newly started business. Also in this question, we are not given any information about the work in progress. So I'm not considering the work in progress also. And from this, we will deduct the closing stock of of the finished goods. So the closing stock of finished goods will be 17 crores 50 lakhs. This will be divided by 3,50,000 into 50,000 units are there in the closing stock. So this will come to 2 crores and 50 lakhs. So dear students, after deducting this, we will be getting our cost of goods sold, which will come to 15 crores. To this we will add up selling, and credit admin overheads. Now this will be for 3 lakh units which are sold into 250 rupees per unit. So this will come to 7 crores and 50 lakhs. So after adding this, dear students, will be getting our total cost. So our total cost, dear students, will come to 22 crore 50 lakhs. Now this particular 22 crore 50 lakhs, dear students, is going to be compared with what, with your sales. And dear students, our sales are 3 lakh units. The selling price is 1000 rupees per unit. So the sales are 30 crores. So dear students, you can see that these sales are more than the more than the total cost. So our profit will be 30 crores minus minus 22 crores and 50 lakhs, which will come to 7 crores and 50 lakhs. Dear students, we can also calculate the profit as 3 lakh units into, we already calculated the profit per unit in the previous working, and the profit per unit in the previous working was 250 rupees. So 3 lakhs into into 250 will also give us will also give us a profit of 7 crores and 50 lakhs. So dear students, our first our first question was to calculate the calculate the profit, the anticipated profit, and the anticipated profit is 7 crores and 50 lakhs, which comes to which comes to 750 lakhs. Let us verify this, and the answer or the suggested answers which are given to us by the institute. As you can see here, the profit that is coming is how much it is? 750 lakhs, which is nothing but 7 crores and 50 lakhs, right? So this is the table that they have prepared, the same table what we have prepared, and the profit calculated over here is 7 crores and 50 lakhs, right? Okay, now dear students, let us go to the second requirement. Now the second requirement, dear students, is asking us to estimate the estimate the current assets required in the first year of operations, and they are asking you to take the data at data at cost, right? So the second part is they are also asking you to calculate the net working capital. So dear students, we will prepare the working capital statement. From that we will be getting we will be getting the gross working capital, that is the total of the current assets, and then we will also be calculating the the net working capital. So the second and third one I'm doing a common working. For that we will be will be preparing the working capital statement. So dear students, now let us do the calculation of working capital. Let us first start with the current assets. In the current assets, first I am valuing the stock of raw materials. So, dear students, as you can see, how we are given or what is the information given to calculate the stock of raw material. So it was given that the stock of raw material is going to be equal to 15% of the annual consumption. So you can see what is our annual consumption over here. Our annual consumption, that is raw material consumption, is what is 7 crores, and 7 crores into into 15% is going to be the stock of raw materials. So 7 crores into 15%. So we'll get 1 crore and 5 lakhs. Second, dear students, there is no work in process. So directly I am taking stock of finished goods. Stock of finished goods, dear students, we have already done the calculation of the valuation of the stock of finished goods. Here you can see that this is a working from which we will be directly getting the closing stock of finished goods, which is 2 crores and 50 lakhs. Third year students, you have to take datas, and they're asking you to value the datas at what, at the cost price. So the datas is going to be valued at the total cost, which is 22 crores and 50 lakhs. The datas collection period, dear students, is what, is 3 months. So it will be 22 crores 50 lakhs into 3 by 12. So this will come to 5 crore 62 lakhs and 50,000. Then we are given the cash balance. So cash and bank is 25 lakhs. So when I take the total of this, I'll be getting gross working capital, and the gross working capital is nothing but the total of what, total of your current assets. So this is coming to 9 crores 42 lakhs and 50,000. So dear students, our second question is to calculate what, calculate the current assets requirement, and the current assets requirement is coming to 9 crores 42 lakhs and what, 42 lakhs and 50,000. Let us check this with the solution that is given. So here is the solution, that is 9 crore 42 lakhs and 50,000. Now let us continue and calculate what, calculate our current liabilities also, so that we can eventually find out our net working capital. So from this I am going to deduct the current liabilities. In that, first is going to be creditors. Now dear students, because this is a newly started business, the creditors will be valued at the raw material purchased, right? So how you will calculate the raw material purchase? So the raw material purchase is going to be raw material consumed plus the closing stock of what, stock of raw material. And what is our creditors payment period? The creditors payment period that was given to us is 1 month. So our raw material consumed was 7 crores. Plus we are having 1 crore 5 lakhs. This total will give you raw material purchased into 1 by what, 1 by 12. So 7 crores plus 1 crore 5 lakhs. So this will give you 67 lakhs 8,333. Second is, we are having outstanding, outstanding expenses. So which and all expenses are going to be outstanding? So labor will be outstanding, cash manufacturing overheads will be outstanding, and our selling and credit administration overheads will be what, will be outstanding. So the total of all the expenses are coming to 18 crores. What is the outstanding period we are having? Outstanding period is what, is 1 month. So this will come to 18 crores into 1 by 12. So this will come to 1 crore and 50 lakhs. So dear students, will be able to calculate the net working capital. So 9 crores 42 lakh 50,000 minus so we are getting a net working capital of 7 crores 25 lakhs 41,667. So our net working capital comes to 7 crores 25 lakhs 41,667. Let us check for the for our options. So here is our option, that is option number option number C, that is 7 crores 25 lakhs 41,667. Let us see what is the solution given by the institute. So here they have given to us, the answer is 7 crores 25 lakhs 41,667. Okay. Now let us go for the for the next understanding. Now, in the fourth part, they are asking you to calculate the annualized percentage cost of two options for reducing the reducing the working capital. And what are the options given by them? So there were two options, as you can see over here. So we are dealing with this particular paragraph now. We are dealing with this particular paragraph. Here it is given that the entity is also considering reducing the working capital requirement by either of the two options. The first option is reducing the credit period to the customers by a month. Right now, the data's collection period is is 3 months. They are planning to change it from 3 months to to 2 months. That means they want to reduce it by reduce it by a month. And if they do this, there is going to be a reduction in reduction in sales by sales by 5%. Second option is they want to engage this with with a factor, where the factor is going to manage everything, and the factor is going to charge as a commission of 2% on the invoice value, and will also advance 65% of the receivables at the rate of 12% per annum. So it's a rate of interest, and directly we are given that he is going to advance only 65% of the receivables. So the interest is straight away going to be calculated on the 65% amount. Okay. And if we appoint a factor, there is going to be some savings, there is going to be some benefit to us. And the benefit is in the terms of reduction of the administration and the and the bad debts. So there is going to be a total savings of of 36 lakhs. So let us analyze both the options and see what is the percentage cost over here. So I'm going with the option A first. In option A, what is our current debtors collection period? Is how many months it is? 3 months. When the debtors collection period is 3 months, what is the amount of debtors that we have already calculated? What is the amount of debtors we already calculated? It is 5 crore 62 lakhs and 50,000. So 5 crore 62 lakh and 50,000. If we go for the debtors, debtors collection period of 2 months, there is going to be reduction in in sales. Now the sales are going to reduce by by 5%. So there is going to be a reduction in sales of 15,000 units. So your sales units will be how much? So it will be 3 lakhs minus 15,000, that will come to 2,85,000 units. If this is going to be 2,85,000 units, then what will be the amount of debtors here? So dear students, amount of debtors over here will be, our total cost is is 750. So 2,85,000 into 750, your new debtors will be 21 crores 37 lakh 50,000 into 2 by 12. So your debtors will be 3 crore 56 lakhs and 25,000. So dear students, as you can see over here, okay dear students, our new data are going to be 21 crores 37 lakh 50,000 into 2 by 12, that is going to come to 3 crore 56 lakhs and 25,000, right? So when the data's collection period was 3 months, the money blocked in datas was 5 crore 62 lakh 50,000. Now if you are changing the data's collection period to 2 months, the money blocked in the datas will be 3 crore 56 lakhs and 25,000. So the difference will be nothing but the cash that we will be receiving from the datas. So that is less amount is going to be blocked in what blocked in datas, right? So we can say that the difference is going to be the benefit to us, which is going to be amount amount realized from datas. So the amount realized from datas will be 5 crore 62 lakhs and 50,000 minus 3 crore 56 lakhs and 25,000. So dear students, this will be 2 crore 6 lakhs and 25,000. So if the data's collection period is reduced by 1 month, there is going to be some benefit, and that benefit is going to be that we will be receiving receiving the money from the data. So how much money will be will be released from the data is 2 crore 6 lakhs and 25,000. Now because there is going to be reduction in sales, there is going to be loss of profit for us. So what is loss of profit? So 15,000 units are reduced, and the profit per unit is how much? It is 250. So the loss of loss of profit is going to be 37 lakhs 50,000. So dear students, 37 lakh 50,000 is a cost for realizing realizing 2 crore 6 lakhs 25,000. So our percentage cost over here will be it will come to 18.18%. So dear students, our first option is first option is giving us a percentage cost of 18.18%. That is our option number option number A. Let us go for for the second option. Right now in the second option, what is the information that is given to us? So we are going to engage with a factor over here, right? And the factor is going to charge you a commission of how much? A commission of commission of 2% of the invoice value, and is going to advance you 65% of the receivables at the rate of 12% per annum. And there is going to be some benefit to us, which is 20 lakhs plus plus 16 lakhs. Okay. So if we talk about the about the second option, if we talk about the second option, as you can see over here, your data's amount is, it is your 30 your 30 crores into 30 crores into 3 by 12. So that is going to give you how much? 7 crore 50 lakhs. The commission is going to be at the rate of at the rate of 2%. So the commission at the rate of 2% is 7 crore 50 lakhs into 2%. So your commission is going to be 15 lakhs. Interest is going to be on 65% amount only. So 7 crore 50 lakhs into 65% into 12% into 3 by 12, that is going to give you 14 lakhs and 62,500. What is the amount of advance? The advance amount is only 65% of the of the amount of the datas. So dear students, you can see that the total cost will be coming to how much? So the total cost will be commission, because it is 3 by 12. This commission has to be paid for paid for 4 times. So 15 lakhs into 4 times will give you 60 lakhs. Interest also 4 times. So it is going to come to 58 lakh 50,000. Then from this we are going to reduce the reduce the savings of 36 lakhs, which is 20 lakhs and plus plus 16 lakhs. So our net cost will come to 82 lakhs and 50,000. So our percentage cost is going to be 82 lakh 50,000 divided by the amount of advance into 100. That is going to give you 16.92%. So dear student, our option number 1 is giving you 18.18%. And the second option is giving you 16.92%. So as you can see in our in our fourth option, we are having 18.18 and 16.92. That is option number option number A, right? Let us check this with the solution that has been given to us. So here you can see that in MCQ number 4, we are having 18.18 and and 16.92%. Now let us go for the last option. That is the last MCQ. Now, in the last MCQ, what are they asking you that? What is going to be the maximum permissible bank finance by the bank and the annualized percentage cost of the same? So here the question comes at which method we have to use for calculating the maximum permissible bank finance. So if you look or if you read the question properly, we are dealing with this particular paragraph now. If you read the question properly, the question itself is telling you which method we have to use for calculating for calculating the maximum permissible bank finance. So here it is given to us that the entity is also considering funding a part of the working capital by bank loan. For this purpose, bank has stipulated that it will grant 75% of the net current assets. So what do you mean by 75% of the net current assets? Means it is 75% of the current assets minus current liability, that is 75% of the working capital as advance against working capital. Right. So what we'll be doing is we already calculated the amount of the working capital. So the amount of the working capital is 7 crores and 25 lakhs 41,667. So 75% of that is going to give you 5 crores 44 lakhs 6,250. Right. So this becomes our this becomes our MPBF, that is maximum permissible bank finance. Now, what is the second part? The bank has quoted 16.5% 5% rate of interest. And there is a condition over here that the current account, we will have to open a current account with the bank, and this current account will have to maintain 10% of the loan amount as the minimum minimum average balance. That means we can only use 90% of the 90% of the funds. So can I say that this particular 16.5% is only for using 90% of the finance? So how much will be for the entire entire 100%? If we do a cross multiplication, we can calculate the calculate the annualized annualized rate of interest, right? So doing this cross multiplication, we will be getting the annualized percentage as is 18.33%. So our last MCQ is giving us giving us an answer of 5 crores 44 lakhs 6,250 and 18.33%. So it is coming as option number option number B. So dear students, this was our first first case study where everything was everything was converted into MCQ format, and we have to solve the entire entire question. Now we will continue with the with the division B, that is the descriptive question, and the first question in that particular section is related to related to ratio analysis, right? Now this is a very simple question. Such type of questions you have already done in the in the class. So I'll read the question first. From the following information and ratios, we have to prepare the prepare the balance sheet as on 31st March 2023, and we have to also prepare the income statement for the year ended on that date for Limelight and Company. What is the information that is given to us in the question? We are given the gross profit amount 1,20,000. Shareholders fund is already given to us. Gross profit margin is given to us. Net profit margin is given to us. PBIT to PBT, PBIT means it is EBIT to EBT. That means we are given given the ratio is 2:1. Credit sales to total sales is 80%. That means whatever is the total sales, credit sale is going to be 80%, and credit sales will be used for calculating calculating the debtors. Then we are given total asset turnover ratio, which is 0.4 times. Inventory turnover ratio is given to us. And they have mentioned a condition that we have to use sales as sales as a turnover. That means the normal formula for calculating the inventory turnover ratio is COGS upon upon inventory. But here they are asking you to use sales upon sales upon inventory. Then the average collection period 360 days a year we have to consider, and the average collection period calculated is 30 days. Current ratio is also given to us. Operating expenses are given to us, which are excluding excluding interest of 60,000. Long-term debt to equity is also given to us. That means we are having long-term debt also, and tax rate is what, tax rate is nil. From this information, we have to prepare what, prepare the balance sheet, and we have to also what, also prepare the income statement. Okay. If we analyze a question, if you understand what is going to be there in the balance sheet, then dear students, first of all, from the liability side, we are going to have shareholders fund. Also, we are given long-term debt to equity. That means in the liability side, we are going to have long-term debt also. Also, we are given the current ratio. That means there will be current liabilities also. So, these are the three items that is going to appear in the balance sheet on the what, on the liability side. On the asset side, because we are given current ratio, that is going to be current assets, and the total asset information is given to us in total asset turnover ratio format. So, the remaining amount will be what, will be fixed assets. Okay. In the current assets, there is a possibility of calculating what, calculating inventory. There is a possibility of calculating what, debtors, and there might be a possibility that we might be having what, having cash also. So when you calculate the current assets, and if your inventory and the what, and the debtors total is equal to the current asset, that means there is no cash. But if your current assets total is not equal to inventory plus debtors, then the balancing figure will be what, is going to be cash. So we are going to first prepare the what, prepare our solution format, and then we will start doing the working and do the calculation and keep on transferring the figures to the what, to the balance sheet as well as what, as well as the income statement. So first I am going to draw the format of what, of the balance sheet. So now dear students, this is our division B. In the B division, we are doing the first question. So first I am going to draw balance sheet. We have to prepare the balance sheet as on 31st March 2023. So this is a balance sheet format: liabilities amount, assets amount. I'm also preparing the income statement. There's going to be a very small income statement in this. Income statement, I'm keeping it in the format of particulars, some calculations, and amount. The income statement is going to be a small income statement. As you can see from the details of the question, because we are having gross profit ratio. So we'll have sales minus COGS gross profit. Then we are given operating expenses. So minus operating expenses, we'll be getting PBIT, that is EBIT. From that, we will be reducing the amount of interest. We'll be getting PBT. And there is no information about the tax. So your income statement will end at what, end at PBT. Okay. So very small income statement as well. I'll just write what is going to come in the income statement. So in the income statement is going to start with what, with the sales minus COGS gross profit, operating expenses, EBIT or PBIT, minus interest, EBT or PBT. So this is going to be your income statement, right? Let us see what is going to come in the balance sheet. In the balance sheet, we are going to first of all have shareholders fund, long-term debt, and because of the current ratio, we are going to have current liabilities. On the asset side, we are going to have fixed assets, current assets, inventory, debtors. Last we can have what? We can have cash. So this is going to be your balance sheet. Now, dear students, let us check what is the information. Is there any figure that is given to us which is related to the balance sheet? And the information is your shareholders fund. Shareholders fund is already given to us. Now, there is no bifurcation, there is no ratio that is given to us which can break the shareholders fund into share capital and reserves. So straight away I am going to write this as 5 lakhs. Okay. Then there is no other figure which is related to what? Related to your balance sheet. Now we are given the information of the what? Of some income statement. So gross profit amount is already available. So I'm going to the what? To the income statement over here. Gross profit amount is 1,20,000. Then we are also given what? Given the operating expenses. Operating expenses are also given to us. So operating expenses are 60,000. So from your gross profit, if I reduce the amount of operating expenses 60,000, your PBIT is going to be 60,000. Okay, now let us start. We can first of all, I think we can prepare the what? Prepare the income statement. So I'm doing the analysis of the income statement first. The gross margin that is given to you. Gross margin means the gross profit ratio is what? Is 40%. So students, we can understand that if the sales are what? Sales are 100. Gross margin is 40. So COGS will come to what? Will come to 60. So we can use a simple cross multiplication here to calculate the sales as well as what? As well as the COGS, right? So we can take sales as 1,20,000 divided by 40 into 100. So the sales figure comes to 3 lakhs. COGS will be, so this comes to 1,80,000. So as you can see, sales minus COGS gross profit, then operating expenses given, and EBIT we have calculated. Okay. Now I think so there is some ratio that is given to us about what? About PBIT and PBT. So that ratio is what? Is 2:1. So I'm doing the first working. PBIT upon what? Upon PBT is 2/1. Now PBIT is already available. So 60,000 divided by PBT is 2/1. So PBT will be 60,000 into 1/2. It will be 30,000, right? So from this ratio, we get what? We get the PBT of 30,000. So interest will be 60,000 minus 30,000. So interest amount comes to what? Comes to 30,000. So our income statement is ready for the what? For the question. Now we are left with what, we are left with filling up what, filling up this particular balance sheet. Okay. So first I'll concentrate on what, on the liability side. So let us understand if we can do anything from the liability side. Now we are given the sales, and there is one ratio that is telling us that the credit sales to total sales is what, is 80%. I just calculate the credit sales amount and keep. Later on I'll require this amount for calculating what, calculating debtors. So as you can see that we have already calculated the amount of what, amount of sales. So second calculation I'm doing over here is credit sale is 80% of the what, of the total sales. So it is 80% into 3 lakhs. So it will come to 2,40,000. This information I'm going to use it, use it later on. Okay. Now, before I calculate the what, the other figures, I will be using total asset turnover ratio to first calculate the what, calculate the total assets, right? So let us use this particular ratio. So we have total assets turnover ratio, which is going to be sales divided by total assets. This ratio is 0.4. So 3 lakhs divided by total assets. Okay, so dear students, our total asset turnover ratio we have used. We have got sales upon what, upon total assets, which is 0.4 is equal to 3 lakhs divided by total assets. So total assets are coming to how much? 7 lakhs and 50,000. Okay. So from this particular total assets, can we conclude that your total assets will be equal to your total liabilities? Which is going to be 7 lakhs and 50,000. So what we can do is we can go up to the balance sheet and we can put these particular figures over here. Our total assets came to 750. Total liabilities also 7,50,000. So this has come from what, from this particular working note. Okay, so our working note number 4. Now I'm using the next information. First I'm concentrating on the liability side, then I'll go for the what, for the asset side. Now from the liability side, I can now use long-term debt to what, to equity. So your long-term debt is 40% of equity, which is 40% of the shareholders fund. So let me calculate this. Long-term debt is equal to equity into 40%. The equity amount is 5 lakhs, which is shareholders fund in this case, into 40%. This will give me how much? 2 lakhs. Now dear students, we have the total liabilities. We have the equity amount, we have the long-term debt amount. So the balancing figure will be what, will be your current liabilities. So the next working I am doing is current liability will be total liabilities minus equity minus long-term debt. So dear students, our total liability is 7,50,000. Equity is 5 lakhs. Long-term debt is 2 lakhs. So from this I can conclude that our current liabilities are 50,000. Now as you can see that our liability side is ready. So I can transfer this entire figures to the balance sheet on the liability side. So our balance sheet liability side shareholders fund was already there. Long term debt we calculated for 2 lakhs and our current liabilities are 50,000. Now dear students, will be using the current ratio to calculate the current assets first. Then the balancing figure will be what will be fixed assets. Then we will concentrate on calculating the inventory, debtors and cash. Okay. So let us first calculate calculate the current assets by using the current ratio. So our 7th working note is current ratio is current assets upon current liability, which is 2/1, that is given to us in the question. So here we are having current liabilities. So current assets, current liabilities just now calculated 50,000. So we can easily calculate the current assets. So our current assets will come to 1 lakh. Also students, if you are having total assets and you are having the current assets also, so the balancing figure will be what will be your fixed assets. So your fixed assets will be total assets minus current assets. So total assets are 7,50,000 minus so your fixed assets will be 6,50,000. So students, we can now transfer these figures to what to our balance sheet. So in the balance sheet, we are having the total of the what of the current assets as 1 lakh. Fixed assets calculated 6,50,000. So what is the pending calculation now? The pending calculation is inventory, debtors and what and cash. Okay. So for this also I think so the information is already given to us in the question. So let me use the next working note. The next working that I'm going to do is about calculating what calculating inventory, and they're asking you to use sales for calculating what calculating the inventory. So I'm using inventory turnover ratio now. Inventory turnover ratio. They're asking to take sales upon inventory. Why I'm using directly inventory and not average inventory? Because there is no information about the opening inventory. So closing will become what will become the average. Now this inventory turnover ratio is how many times? It is 5 times. Sales are 3 lakhs. So inventory will be 3 lakhs divided by 5, which will come to how much? 60,000, right? So our inventory value we have got of 60,000. Next, now I can calculate what calculate the debtors, because we are given the what given the average collection period, and the average collection period is what is 30 days. So let me use this. I'll use the direct formula for calculating this. So this will be equal to debtors upon credit sales into 360 days as mentioned in the question. So this is 30. Debtors we have to calculate. Credit sales was 2,40,000. into 360. So debtors, dear students, will be 2,40,000 divided by 360 into 30. So this will give you 20,000. So students, you can see that we are having what, we are having the amount of inventory as what, as 60,000, debtors is 20,000. So 60 plus 20 comes to 80. But our current assets are how much, are 1 lakh. That means the difference will be what, will be cash. So I'm calculating cash. Is current assets minus inventory minus debtors. So current assets are 1 lakh minus inventory of 60 and debtors of 20. So dear students, our cash balance will come to how much? 20,000. So 60,000, 20,000, 20,000 is the bifurcation of what, of the asset side. Students, it is compulsory that we will have to show all the workings that we have done over here. So your inventory value will be 60, debtors will be 20, and the cash balance will also be 20. So this is your balance sheet for the question. Let us check the solution of the institute. This is the income statement that what we have prepared. The same income statement that is starting from what, sales of 3 lakhs, and here also 3 lakhs, ending at what, at 30,000. This is the balance sheet which has been prepared. As you can see, balance sheet, liability side, the equity share capital they have written over here. It is nothing but it is equity, which is 5 lakhs, 2 lakhs and 50,000. Fixed assets are 6 lakh 50,000. Current assets bifurcation is 60, 20, 20. Okay. So this was our first question from the descriptive part. Okay students, now the next question is from the cost of capital chapter. Similar question we are already having in our textbook. So we have already solved a similar type of question in the classroom. Now see what is given to us in this particular question. We are given that Toto Limited has the following capital structure as on 31st of December 2023, which is considered to be optimum. Now, what do you mean by optimum? That means this is going to be their best, best capital structure. This is going to be the best combination for whatever projects they are going to do in the, in the future. Okay. So, this is going to have 12% debentures. This is going to have 10%, 10% preferential capital. So, there is going to be debt, there is going to be preference, and there is going to be equity shares. So, if we talk about the total of the, total of the capital, then it is coming to coming to 4 lakh 50 plus 1 lakh 50 will give you 6 lakhs, and 6 lakhs plus 24 lakhs will give you will give you 30 lakhs. So, out of 30 lakhs, if the debenture value is 4 lakh 50, so the proportion of the debenture in the optimum capital structure, that is the weights, is going to be 0.15. Then out of 30 lakhs, preferential capital is 1 lakh 50,000. So this is going to be 0.05. And the remaining 80%, that is 0.80, is going to be the amount of amount of own funds, that is nothing but equity, right? So whatever new project they want to do, they are going to raise the funds in this particular this particular combination. Now the company's share price has a current market price of of 30.25 per share. So this is this is the current market price which is given to you, which is nothing but 30.25 is going to become is going to become P0. Then the expected dividend per share in the next year is 50% off. It is going to be 50% off 2023 EPS. So you can see that 2023 EPS is is 3.023. So this is expected dividend. That means we are talking about about D1 is 2023 EPS into 50%. So what is your 2023 EPS? Your 2023 EPS is 3.023 into 50%. So this will come to, D1 is going to come to 1.5115. This is going to be your D1, right? Now, the EPS of the last 10 years are as follows. So, we are given the EPS of what of the last 10 years. The past trends are expected to continue. They are telling that this particular trend is going to continue. So, dear students, whenever it is such a type of such type of information that is given to us, this information is always given to us so that we can calculate the calculate the growth rate from this. So, to calculate the growth rate, we take the information of the last 2 years. We take the information of the last 2 years. So, how we are going to calculate the growth in this particular case? So, the growth rate is going to be calculated as 3.023 minus 2.723 divided by 2.723 into what into 100. This is going to give you the growth rate. So, 3.023 minus 2.723 divided by 2.723, and we are getting it as what as 3.023 minus 2.723 divided by 2.723 percentage. So we are getting this as 11.01%. That is nothing but the institute has taken this as a round off percentage of what of 11%. So dear students, our growth rate is going to come to how much? It is going to come to 11%. Okay. Now, this information is available so that we can calculate what calculate KE from the what from P0, D1 and what and G. Now we are also given that the company can issue 14% new debentures and 12% new preference shares. The company's debenture is currently selling at 99. That means if we are going to issue the new debenture, this 99 will become what will become the net proceeds for what for the debentures. Then we are given that the new preference issue can be sold at a net price of 9.90. So this is the net proceeds for what for the preference, and there is a preference dividend of how much 1.25 per share. The company's marginal tax rate is what is 50%. There are 4 requirements of the question. The first one is that we have to calculate the after tax cost of new debt. That means we have to calculate the new KD. New preference shares means new KP. And we have to calculate the calculate the ordinary equity. That means you have to calculate the KE also, assuming the new equity comes from the retained earnings. That means actually we are supposed to calculate what calculate KR, but your KR is going to be equal to what equal to KE in this particular case. Once you calculate the individual cost of capital, the second requirement is that we have to calculate the marginal cost of capital for the new funds raised. That means if you are going to do the new project, so your new project will involve a new cost, and what is going to be the new overall cost of capital? That is what we have to calculate by using this particular weights, that is weights of 0.15, 0.05 and 0.80. So our first concentration will be on calculating the individual cost of capital. Then we will go for the calculation of what calculation of the overall cost of capital. Okay. So when you want to calculate the individual cost of capital, I am doing some rough calculations over here. Our new debenture is what is 14%. So if you calculate the amount of interest over here, so interest will be 100 into what into 14%, which will come to what which will come to 14. Then we are already having the net proceeds of the of the new debenture, which is 99. So this particular debentures, there is no information about the redemption. That means these are what these are perpetual debentures, and this from this particular perpetual debentures we can calculate what we can calculate our new KD. So let us see how the new KD is calculated. So our new 14% debentures KD is interest into 1 minus tax upon net proceeds into 100. So our new KD will come to 7.07%, which is nothing but 14 into 1 minus tax upon net proceeds, which is 99. So this is the proper formula used over here. From this we can calculate our calculate our new KD, which will come to 7.07%. Like this, we can also calculate calculate the new KP, which is going to be preference dividend upon net proceeds into 100. So the preference dividend is already given to us in the question. The net proceed is also available in the question. So we are getting our new KP as 12.63%, right? Now, then we can calculate the calculate the KR, which is going to be equal to equal to KE. So we already calculated D1. So this particular this particular calculation is D1. This is our this is our P0, and plus growth rate will give us will give us our KE of KE of 16%. So our 16% is is going to be our KR. So dear students, our individual cost of capital is already calculated. Now if we go for go for the marginal cost of capital. So the marginal cost of capital, what is going to be the weights over here? The debentures will be 0.15, preference shares will be 0.05, equity is going to be 0.80. Here equity is nothing but it is it is your retained retained earnings. So our individual cost of capital already calculated 7.07, 12.63 and 16%. So if you multiply this, we are able to calculate the marginal cost of capital. So let us just check this. 7.07 into 0.15 is going to give you 1.605. Then 12.63 into into 0.05, this is going to give you 0.6315. And 16 into 0.8, this is going to give you 12.8, right? So plus so this comes to 14.492%. So this is this is your new KO, that is your marginal cost of capital. So this becomes this becomes your KO, that is overall cost of cost of capital. So the first and the second part is done. Now let us see what is the requirement of the third part. Now in the third part, they are telling that how much can be spent for the capital investment before the new ordinary shares must be sold. The marginal cost of capital remains to the remains to be constant, assuming that the retained earnings available for the next year's investment is 50% of the 2023 earnings. So dear students, our D1 was 1.5115. So our retained earnings per share will be 1.5115. Let us check how many how many number of old shares we are having. So there are 2 lakh shares over here. So if you multiply this by by 2 lakhs, you get your total total retained earnings. So this comes to 3,02,300. Now this 3,02,300 in our capital structure is going to comprise of comprise of the weight of 0.80. So if you want to do the new project, how much you should be investing? So we do the cross multiplication and we get 3,77,875. Okay, so let us check for the solution. Okay, see here. So the retained earnings which has been calculated over here is 3,02,300. That is what we had calculated. Now, if we do the cross multiplication, this is your cross multiplication. So we get that we can do that means we can do the new project of 3,77,875. Okay, so this is going to be this is going to be the calculation of your new project. That means if you're going to do the new project with the retained earnings, maximum you can do the project of 3,77,875. If you want to do a project which is having a cost more than this particular amount, then you will have to go for the issue of issue of the new equity shares. So the next question is, what will be the marginal cost of capital, where the cost of funds raised in excess of the amount calculated in the third part, if the company can sell the new ordinary shares of rupees 22 per share. So dear students, that means if you want to do any new project which is going to have a cost of more than 3,77,875, then we will have to go for the issue of issue of new equity shares, and the new equity shares can be issued for 22 rupees per share. That is going to change your KE calculation. If your KE calculation will change, your KO calculation will also change, right? So we'll first calculate the new KE. So in that case, your new KE is going to be, so this is going to be your D1 is going to remain same. That is going to be divided by what, by 22, plus the growth rate is also what, also same. So your new KE is going to be what, is going to be 17.87%. So this will become your new cost of what, cost of equity. Now from this particular this particular calculation, we can recalculate our our overall cost of capital. So if you want to do a new project, again the proportion will be 0.15, 0.05 and 0.80 from the new equity shares. Your KD is going to remain constant. Your KP is going to remain remain same only, but your new KE is going to be 17.87. So by multiplying this, we can then calculate our new marginal cost of marginal cost of capital. So when you calculate the new marginal cost of capital, both these calculations are going to going to remain same. Then 17.87 into 0.8, it is going to give you 14.296. When you take the total of this, we get this as 15.988, and therefore the 15.988 is going to become your new marginal cost of capital, that is overall cost of capital. So dear students, the same question, similar question we are already having in our in our study material, and we have already solved this question in the class. Let us move on to the next question now. The next question is about capital structure, and in the capital structure, this is about the capital structure capital structure theory question, where they have asked where they have asked you to use approach. So let us first read the question and understand what is the requirement of the question. Now, the following data is available in respect of two companies having the same business risk. Now, the same business risk means operating leverage is going to remain remain same for both the companies. That means contribution upon EBIT is same. That means for both the companies, contribution will be same. For both the companies, EBIT will also be same. Capital employed is 3 lakhs. EBIT is already given to us in the question. So, the EBIT is how much? It is 45,000. For both the companies, the EBIT will be same. KE is 12.5%. Now, A Limited is a levered company. That means it will be having debt. B Limited is what is unlevered company. That means it will be having no debt. So, what is the combination of these 3 lakhs? For A Limited, you are having 10% debt of 1,50,000 and equity of also also 1,50,000. In B Limited, there is no debt. The entire amount is is through equity. An investor is holding 20% share. So the question is telling you that an investor is holding 20% shares in the levered company. We have to calculate the increase in the annual earnings of the investor if he switches his holding from levered to levered to unlevered company. So dear students, this particular question is from the capital structure, capital structure theory. Approach we have to apply over here, and we have to use the arbitrage and calculate the calculate if there is any increase in increase in earnings if the investor is switching from from levered to unlevered. So for that, we'll have to first calculate the calculate the value of both the both the companies. So to calculate the value of both the companies, we will start with we'll start with the EBIT that is given to us. So as you can see, the EBIT that is given to us is going to remain same for same for both the companies, that is 45,000, 45,000. A Limited is levered, so we have to deduct the amount of interest. So 1,50,000 into 10% debt, The amount of interest for A Limited is 15,000. So we get earnings available to the equity shareholders, which we'll normally call it as what, call it as NI. That is net income. Net income is net income available for the equity shareholders. Then KE is given to us in the question, which is going to remain same for what, for both the firms. Then we will be first calculating the value of equity. So how do you calculate the value of equity? So our formula is NI upon what, upon KE. So the value of equity is 30,000 divided by 12.5%, that is 2,40,000 for what, for A Limited, and 3,60,000 for what, for B Limited. To this, we will be adding up what, adding up the value of the debt, which is only there in A Limited, not there in B Limited. So we get the value of what, value of the firms. So here you can see that A Limited, which is a levered firm, is having a value of 3,90,000, and B Limited, which is unlevered, is having a value of only how much? 3,60,000. So dear students, both the firm, because they are having same EBIT, the value has to be same, but the value is not same by doing this particular calculation. So you can see here that the levered firm is overvalued and the unlevered firm is what, is undervalued. We are given in the question that investor is holding 20% shares in the levered company, means 20% shares in the overvalued company. So what is he going to do now? He is going to sell his holdings of the shares in the overvalued company and is going to shift to the what, shift to the undervalued company. So in this particular process, because he is holding 20% shares, he is first going to sell his holding of 20%. So what is the value of the equity shares in the levered firm? It is 2,40,000. So if he is selling the what, selling the shares, how much money he is going to receive? So there is going to be sale of what, sale of shares in A Limited. So we are having his holding, we are having the market value as 2,40,000. So he will be having 2,40,000 into 20%. So he will get a cash of 48,000. Dear students, he will be taking a personal loan. Now, how much personal loan is going to take? So what is the amount of debt we are having? It is 1,50,000. His holding is 20%. And this personal loan is going to be at the rate of 10% interest, right? That is assumption of what, of MM. This particular personal loan, dear students, is taken to maintain the financial risk of the what, of the investor. So he is going to take a loan of how much? Of 30,000. So what is the total available funds with him? So he is having available funds as what, as 78,000. So this is going to be the first calculation, that he is going to sell the shares, he is going to take a personal loan. So now the total funds available are what, 78,000. This 78,000 students is going to invest entirely in the undervalued company, and then we will calculate what is going to be his new percentage holdings. So we are going to invest the entire 78,000 in B Limited, which is undervalued. So what is going to be the new percentage holdings? So the new percentage holding will be 78,000. He is going to invest this out of 3,60,000. His share is going to be 78,000. So this is going to be divided by 3,60,000 into 100. So his new percentage holding is going to be 21.67%, right? So he has invested this entire 78,000, and this entire 78,000 invested in the equity shares of the undervalued company gives him a percentage holding of 21.67%. Now we will calculate what is his earnings before arbitrage and after arbitrage. So let us check the earnings before arbitrage first. Now dear students, before the arbitrage, the NI was how much? NI of the NI of the levered firm, that is A Limited, was 30,000. So he was he was holding 20% shares. So his NI was 30,000 into 20%. So he was earning 6,000. What will happen after arbitrage? After arbitrage, his NI will come from will come from B Limited. Now B Limited's NI is 45,000, but his percentage holding has increased now. It has become 21.67%. So this will be 45,000 into 21.67%. So he will be getting 9751.5. From this, dear students, because he has taken loan, he is going to pay pay interest. He has taken a loan of how much? So he has taken a loan of 30,000, as you can see, and the rate of interest is is going to be 10%. So he is going to pay interest of 30,000 into 10%. He is going to pay interest of 3,000. So his net earnings will be, is going to be 6751.5. So before arbitrage he was earning 6,000. After the arbitrage he is earning how much? 6751.5. So his net gain comes to 6751.5 minus 6,000, which comes to 751.5. This will become this will become his arbitrage arbitrage gain. If he's shifting from shifting from overvalued firm to to the undervalued firm. Let us check the solution given by the ICAI. Yeah, here it is. It is incremental income due to the arbitrage is 751. They have done the round off. We are getting 751.5. That is a round off difference of 1.5. Okay. So now we are going to go for the next question, and that is from that is from the chapter of leverage. Now this is also a very simple question. Similar type of question we have already done in the in the classroom. Now what is given in the question? Now, from the following financial data of a company A and company B, we have to prepare their income statement. So, the requirement is to is to prepare the income statement. So, we are given the details of of two companies, that is company A, company B. The variable cost for company A is already given to us, and the variable cost for company B is is 50% of the sales. Then the fixed cost is already given to us, which is 26,500 for A company. For B company, we have to calculate. Interest expense for both the companies are given. Financial leverage of company A is given to us. For B, you have to calculate. Margin of safety is not given for A company, but the margin of safety is given for for B company. Dear students, whenever margin of safety is given, this information we can use for calculating the operating leverage, and the formula of operating leverage is 1 divided by margin of margin of. So the formula that we can use is is operating leverage is equal to 1 divided by by margin of safety. So if we take 1 divided by 0.25, we'll get the operating leverage of leverage of 4 for for the B company. Income tax rate is is 30%, and EBIT of of B company is given, but for A company it is not given. So from this we will have to prepare the prepare the income statement. Because we are given up to the tax rate, your income statement will go till it is going to go till your earnings after tax. So for both the companies, we have to do do certain certain calculations. So first we'll prepare the prepare the income statement for both the companies together. So this is our question number 4. We'll have company A and company B. The income statement will start from sales minus variable cost for both the companies. We get contribution minus fixed cost. We get EBIT minus interest. We get EBT. The tax rate for both the companies is already given to us, which is 30%. So we get earnings after tax. First, I'll substitute whatever is the information available. So for company A, first of all, we are having variable cost, which is 88,000. Then for company B, it is 50% of the sales. Fixed cost is given for A Limited, which is 26,500. Then interest expense for both is given to us, 14,000 and 11,000. And the other details we are having EBIT for which company, for B Limited, EBIT is 14,000. Okay, now for company B and for for company A, we have to fill up this we have to fill up these income statements, right? Okay, first we'll only concentrate on company A, then we'll go for go for company B. Now, in company A, what are the details we are having? We are first given financial leverage. So we can use the use the financial leverage formula, which is going to be EBIT upon upon EBT. So if you use the financial leverage formula, for company A, which is EBIT upon upon EBT, so that is EBIT upon EBT minus minus interest. If you do this calculation, you will be able to calculate calculate the EBIT for for company A, which will come to 17,000 17,500. So here the EBIT will come to 17,500. So EBT will come to 3,500. So 3,500 into 30% will give you tax 1050. So after tax will come to 2450. So this is a lower part of the of the income statement. Okay, so to calculate the contribution, we have to go reverse now. So the reverse is EBIT plus plus fixed cost. So the contribution is coming to 44,000. So the contribution over here is, now to the contribution of 44,000, we are going to add up add up the variable cost to calculate the calculate the sales. So 88,000 plus 44,000 will give you 1,32,000. So this is the income statement for for company A. Okay, so this is the sales calculation. You have to show all the workings. Now for B, as I told you, that operating leverage we can calculate by using 1 divided by margin of safety. So 4 will be will be your operating leverage. So from this we can first calculate the contribution over here. So the contribution amount will come to 56,000. Then we can calculate the calculate the fixed cost also, right? So the fixed cost is going to be contribution minus EBIT. So 42,000 will be the fixed cost. Once you get this, you are already having interest. So you can already calculate the EBT, which will come to 3,000. 30% tax, so 900 will be tax. So 2,100 is going to be your earning after tax. Now for company B, they are telling that we are having having the variable cost as 50% of sales. So variable is 50%, contribution will also be also be 50%. So like this, from this we can calculate the amount of amount of the contribution as well as amount of the sales. So sales amount will come to 1,12,500. That means your variable cost will also be 50%, which is 56,000. And 1,12,000 will be the amount of amount of sales. So dear students, this was also a very simple question with respect to the detailed chapter. Okay, now dear students, the next question is about the investment decisions, which is nothing but your capital budgeting question. Similar question we have already done in the classroom. Okay, so I'll first go through the entire question. HMR Limited is considering replacing a manually operated old machine with a fully automatic new machine. So this particular question is regarding the replacement of the of the machine. So what do you mean by the replacement of a machine? We are going to sell the old machine and we are going to buy buy a new machine. So they are going to replace this old machine with a fully automatic new machine. The old machine has been fully depreciated for for tax purpose. So this is an important statement. It is it is fully depreciated for for tax purpose. That means for tax purpose the WDV is is 0, but it has a book value of 2,50,000 on 31st March. The machine has begun causing problems with the with the breakdowns, and it cannot fetch more than 40,000 if sold in the market at present. It will have no realizable value after 10 years. The company has been offered 1,50,000 for the old machine as a trade-in on the new machine, which has a price before allowance for trade-in of rupees 6 lakhs. That means if you buy the new machine from this particular this particular buyer, he is ready to give 1,50,000 for the for the old machine. Trade-in means it is in in exchange. The expected life of the new machine is 10 years with a salvage value of 35,000. Further, the company follows written down value method of depreciation at the rate of 10%. But for tax purpose, straight line method of depreciation is used. So dear students, we are interested in the method of depreciation for for tax purpose. So for tax purpose, a straight line method of depreciation is going to be used. Considering this is the only machine in the block of asset. So we are having the block of asset also over here. A working capital of 50,000 will be needed, and it will be released at the end of the end of the 10th year. Now given below are the expected sales and cost from both the both the old and the new machine. So we are given the annual outputs of both the machines, selling price of both the machines, annual operating hours is is same for both the machines, that is old as well as new. The material cost per unit is also also same under both the both the machines. Labor cost per hour in the old machine is 50, but in the new machine it is 75. Indirect cash cost per annum is 1 lakh for old machine, 1,75,000 for the new machine. From the above information, analyze whether the old machine should be replaced or not. If the opportunity cost of capital of the company is 10%, so this is going to be our discounting rate. Also, the income tax rate is is 30%. Further, assume that the book profit is treated as ordinary income for tax purpose. Also, estimate the internal rate of return of the replacement decision. Okay, all the calculations to be calculated to to 3 decimal places. So, dear students, is a simple question of replacement where we will have to use the incremental approach. Incremental approach is nothing but it is a differential approach. That is what we will have to follow. Okay, so we will prepare our format of solving the question. So this is our question number question number 5. We are going to do the calculation of incremental NPV. So we are going to have serial number, particulars, cash flows, discounting factor at the rate of 10%, and the present values. First we are going to calculate PVCI. This PVCI is going to be compared with the PVCO, and then we will be calculating the NPV. If PVCI is more than your PVCO, NPV is going to be positive, and vice versa. Okay, so let us start with the with the flow of the question. So first we have to buy the buy the new machine for 6 lakhs, and there is going to be an exchange of the of the old machine, and the exchange price is 1,50,000. So we will be first writing this as incremental cost of the new machine. So incremental cost of the new machine, 6 lakhs is the cost, exchange value is 1,50,000. The incremental cost comes to 4,50,000. The timing of this 4,50,000 is today, that is year 0. So the discounting factor used is 1. So the present value is going to be 4,50,000. Then let us check if there is any scrap value. So we are given that the scrap value of the of the new machine is going to be 35,000 at the end of the 10th year. And the old machine is not going to have any scrap value. So the incremental scrap value will be 35,000 minus 0. So incremental scrap value at the end for the new machine, it is going to be 35,000. No scrap value for the old machine. So this is 35,000. This 35,000 is the value at the end of which year? End of the 10th year. So calculate the present value for this. So the discounting factor at the end of the 10th year is going to be 0.386. So 35,000 into 0.386, this is going to give you 13,510. Now dear students, from the old machine, the WDV of that particular machine is 0 for for the tax purpose. And we are getting we are getting 1,50,000 as as the selling price. So this entire amount is is short-term capital gain for us. And on this short-term capital gain, you have to pay pay the tax. So this tax payment is going to result into into cash outflow. So the second cash outflow over here is going to be tax payment on short-term capital gain, which is 1,50,000 minus 0. So entire gain is 1,50,000 into 30% is going to be the tax. So tax payment of 45,000 will come. Now this tax payment can be taken at the start of the year also or at the end of the year also. That is the first year. But institute has taken this at the start of the year. So we are going to keep it at the start of the year. So the discounting factor is going to be 1. So the present value will come to 45,000. Okay. So these were the these were the points which were related to the new machine as well as as well as the old machine. Now we are given that there is going to be a working capital of 50,000 needed, and that particular working capital is going to be released at the end of the 10th year. So working capital today is going to result into cash outflow. So investment in working capital, the amount of the working capital is 50,000. Timing is year 0, so discounting factor 1. Present value will be 50,000. Now this working capital is going to be released at the end of which year? End of the 10th year. So this will result into cash inflow. So we write here release of working capital 50,000 end of the 10th year. So discounting factor will be 0.386, which is already calculated. So this gives you 19,300 present value. Now dear students, what is pending is nothing but what the calculation of what of the CFAT, that is cash flows after tax, that is going to be incremental cash flows after tax. So the next inflow will be total incremental cash flows after tax per annum. For this we need to do a working of the calculation of the CFAT. So the calculation of incremental cash flows after tax per annum. So the particulars, calculations and amount. So first is going to be incremental sales. So the sales units for the new machine is 80,000, for the old machine it is 60,000. So incremental comes to 20,000, selling price remaining the remaining the same. So I'm writing the working as 80,000 minus 60,000 into 18. So the incremental sales will be 3,60,000. So dear students, this incremental sales is nothing but the sales we are going to generate from the new machine minus the loss of sales that we are going to lose it from the sale of sale of the old machine. From these incremental sales we are going to reduce. The next is incremental material cost. So the incremental material cost will be same, that is 80,000 minus 60,000, and the material cost is what is 5 rupees per unit. It is 5 rupees per unit. So this is 20,000 into 5, that will come to 1 lakh. Then we will have less. Next cost is a labor cost, but the labor cost is per hour. The hours remaining same, but the rate is what rate is different over here. So less incremental labor, 75 minus 50, the rate is changing, but the total number of hours are 2,000 2,800. So this will come to 70,000. Then we have less incremental indirect cash cost. So the new cost is going to be 1,75,000. The old cost which is going to be saved is 1 lakh. So this will come to 1,75,000 minus 1 lakh. So the incremental cost will be 75,000. So 360 minus all the cost will give you 1,15,000. This is your incremental cash flows before tax per annum. Now this cash flow before tax per annum, we are going to reduce incremental incremental depreciation. So less incremental depreciation per annum. Students, for incremental depreciation, for the old machine, it has already been been written off, and therefore there is no loss of depreciation from the from the old machine. So here the incremental depreciation will be depreciation of the new machine minus minus 0. So what will be the depreciation of the new machine? We will have new machine cost is 6 lakhs minus 35,000 is the scrap value, divided by divided by 10, minus no loss of depreciation because the old machine is fully depreciated. So 6 lakhs minus 35,000 divided by 10 will give you 56,000 56,500. This will be your incremental depreciation. So we get incremental net profit before tax per annum. So we get this 58,500. From this we reduce incremental tax. Which is at the rate of 30%. So we get incremental net profit after tax per annum. So 58,500 into 30% will give you the amount of tax. So 17,550. You reduce these, you get NPAT 40,950. To this you add back incremental depreciation per annum, which is 56,500. So you get incremental CFAT per annum. Now this incremental CFAT is every year for how many years? For 10 years. So this will give you 97,450. So dear students, this is your incremental CFAT for every year for how many years? For 10 years. So 97,450. This I will transfer it to to our table. So 97,450. Now because this is annuity for how many years? For 10 years. This is going to be multiplied by the annuity factor. So the annuity factor for for 10 years will come to 6.145. So 97,450 into 6.145. This will give you 5,98,830. So dear students, this is our this is our total PVCI, and this will become our our total PVCO. So let us take the total of all the all the PVCIs. So the total of the PVCI is 6,31,640. And the total of of all the PVCO is coming to 5,45,000. So dear students, the third calculation will be NPV. This is what we have calculated at the rate of 10%. PVCI minus minus PVCO will give you 86,640. So there is a positive NPV of 86,640. That means this particular project or this particular replacement has to be has to be accepted. Let us check for the solution of the institute. So 86,543 and we have calculated 86,640. This small difference is because of one of the factors. They have taken as 6.144, we have taken 6.145. that is the only difference. Otherwise the rest all the calculations are are same. So this was our this was our NPV calculation. Now the question is also asking you to calculate calculate the IRR of the of the project. For calculating the IRR at the rate of 10%, we are having a positive NPV. So now we will have to now we'll have to calculate one NPV that is that is negative. Then we use the interpolation, and then we calculate the calculate the IRR. So the institute over here has taken taken a higher rate, which is which is say 20%. Now considering this 20%, they have calculated the calculated the NPV. So what we'll be doing is we'll be using our same same calculation, but there we'll be using the discounting factor as as 20%. When you calculate the NPV, you will be getting a negative NPV of 1,22,720. So dear students, from 10%, if your NPV is positive, we understand that the IRR is more than more than 10%. When you go for 20%, your NPV is becoming becoming negative. That means your NPV, that means your IRR is less than less than 20%. So somewhere between 10% and 20% falls your falls your IRR. So by using the using the interpolation, our cross multiplication formula, we have calculated the calculated the IRR. So the IRR calculated over here comes to comes to 14.14%. So for this particular for this particular situation, we are having NPV positive, will accept it. Our IRR is also also more than the cost of capital. So as per IRR also we are going to accept the accept the project. So this was our capital budgeting question, which was a normal question that has been done in the in the class. Okay students, now the next question is from the chapter of dividend policy or dividend decision. So it's a very small question, and this is regarding your hypothesis or approach. So I'll just go through the question. MCO Limited has a paid up share capital of rupees 10 lakhs and face value of rupees rupees 10. So the paid up share capital is how much? It is 10 lakhs. Face value is is 10. So what will be the number of equity shares? The number of equity shares will be 10 lakhs divided by 10. So the number of equity shares, old number of equity shares, we can say it is how much? 1 lakh. The current market price of the share is rupees 20. So right now the current market price of the share is 20. So this becomes your your P0. So what is the current value? What is the current market value of the firm? It is 1 lakh shares into 20 rupees market price. So the current market value of the firm is 20 lakhs. Then the board of directors of the company has an agenda of meeting to pay a dividend of 25% to its shareholders. So this is the rate of rate of dividend, and this rate of dividend will be applied on the face value to calculate the amount of dividend. The company expects a net income of 5,20,000 at the end of the current financial year. So this is your income, which is nothing but what the earnings as we call in this particular chapter. Then we are also having that the company also plans for a capital expenditure for the next financial year for a cost of rupees 7,50,000. So this particular 7,50,000 is nothing but is a planning of what of the investment of the new investment. Now, because it is given that the company is expecting to pay a dividend of 25% in the future, so 25% will be of this 10 rupees. So this will give you D1. So D1 will be 10 into what into 25%. So this will come to rupees 2.5 per per share. Now, the company has also planned for a capital expenditure for the next financial year for a cost of rupees 7,50,000, which can be financed through the retained earnings and the issue of the new equity shares. The company's desired rate of investment is 15%. So, this is expectation of the company, which is going to be called as what KE in this particular case. Now, you are required. Following the Modigliani-Miller, that is hypothesis, you have to determine the value of the company in two situations. The first situation is if the company does not pay dividend, and the second situation is if the company is what is going to pay the dividend. So dear students, you know that hypothesis, whether the company pays a dividend or whether the company does not pay the dividend, in both the cases, the market value of the firm is going to remain what remain same, right? So what is objective? The objective is that we have to calculate the calculate the market value of the company. So this will be done in done in three steps. First, we will be calculating calculating P1 for both the situations. Then we will be calculating the number of number of new shares to be issued in both the situations. And then the third area will be what calculating the market value of the company. So we'll be dividing this particular question into what into two parts. So this is our question number 6. We'll divide the solution into two parts: when the company does not pay the dividend and when the company pays the dividend. So here it is, does not pay dividend, and here it is, company will pay dividend. Okay, now when the company does not pay the dividend, we are given the P0 in the question. So P0 is how much? It is 20. D1 will be equal to what? Equal to 0. And KE, that is given to us in the question, which is 15%. So KE will be 15%. When the company will pay the dividend, your P0 will remain what? Remain 20 rupees. D1 will be how much? It will be 2.5 per share. And KE is going to remain at what? Remain at 15%. So dear students, the formula that we will be using is to calculate P0 is equal to D1 plus what plus P1 upon 1 plus what 1 plus KE. This is the formula we have to use to calculate what calculate P1 when the dividend is not paid or whether the dividend is paid. So here we have 20 is equal to 0 plus what plus P1 upon 1 plus 0.15. So 20 will be equal to P1 upon 1.15. So P1 is equal to 20 into 1.15. So dear students, when you multiply this, your P1 will be how much? Will be 23. So when the dividend is not paid, the P1 is what is 23. This is the price at which the new shares will be issued. So we are first calculating what calculating P1. Now if the company pays the dividend, the same formula is going to be used. So P0 will be equal to D1 plus what plus P1 upon 1 plus what 1 plus KE. So here also 20 will be equal to, here the dividend is how much? It is 2.5 plus P1 upon 1.15, that is 1 plus 0.15. So dear students, here we will be getting 20 into 1.15 is equal to 2.5 plus P1. So P1 is equal to 23 minus 2.5. So P1 in this particular case, dear students, will be 20.5. That means when the dividend is what? Dividend is not paid, the new shares will be issued at 23. But if the dividends are paid, the new shares are going to be issued at what? At 20.5. So this was the first calculation of what? Of P1. Now the second calculation is going to be that how many number of shares the company will be issuing in each situation, that is when the dividend is not paid and if the dividend is paid. So let us go for the second calculation. So the second calculation is number of new shares to be issued. So dear students, our investment requirement is how much? It is 7,50,000. This is our investment requirement. Now we are already having, the company is already having an earnings of how much? 5,20,000. So this 7,50,000 is going to be financed from two sources. The earnings are 5,20,000. Now, in the first case, the company is not paying any any dividend. And if the company is not paying any dividend, so out of this particular earnings, the dividend amount will be what? Will be 0. So, entire 5,20,000 can be used for what? For the new project. So, what is going to be the new equity share capital? So, it will be 7,50,000 minus 5,20,000. So, this will come to 2,30,000. So, dear students, here the requirement is 2,30,000 and the price at which the shares are going to be issued is at P1, so that is 23. So, the number of new shares to be issued is 2,30,000 divided by 23. So, this will come to 10,000. So, in this particular situation, the number of shares to be issued is how much? It is 10,000 shares. Now, let us go for the second situation when the dividend is paid. Here also the investment requirement is 7,50,000. Here also we are having earnings of 5,20,000. The company will be paying what? Paying dividend. So how many number of shares were there? So old number of shares are 1 lakh. So 1 lakh into 2.5 is the what? Is the dividend per share. So if you take 1 lakh into what? Into 2.5, the company is going to pay a dividend of 2,50,000 from this particular earnings. So how much will be left for the new project? So for the new project, the amount that is going to be left is what? Is only 2,70,000. Now the company requires what? Requires funds of 7,50,000. Out of that, 2,70,000 is already available from the retained earnings. So what will be the amount of new equity shares that the company will have to issue? That will come to how much? So new equity share capital will come to 4,80,000. So number of new shares to be issued is 4,80,000. This will be issued at what, at P1. What is the P1 in this particular case? It is 20.5 as already calculated. So this will be divided by what, by 20.5. So the number of shares are going to be issued is 23,415. So these are the these are the number of shares to be issued in what, in each case. Let us verify the solution up to this particular stage. As you can see here, here it is when the dividends are not paid. When the dividends are not paid, the P1 is what, is 23 as we calculated. And the number of new shares to be issued are what, are 10,000. Now this is when the dividends are paid. When the dividends are paid, the P1 is what, is 20.5. And the number of shares to be issued is 23,415 shares. These two calculations we have done. Now we'll go for the last calculation, that is to calculate the value of the value of the company. So let us do the calculation of the value of the company in both the cases. So the third calculation will be so the first situation was dividend not paid. The second situation is dividend is paid. So we'll start with number of shares hold. In both the cases, we are having 1 lakh shares. To this, we will add new shares issued. So when the dividend is not paid, the number of new shares issued are what, 10,000. When the dividend is paid, the number of new shares issued were 23,415. So we will be getting total number of shares. Here it will be 1,10,000, 1,23,415. Now students, if you want to calculate the value of the company, this has to be first multiplied by what, multiplied by P1. So in both the cases, we'll multiply this by P1. Here the P1 was 23, here it was 20.5. So we get the value of the company at the end of year 1. So 1,10,000 into 23, we get 25,30,000. And here 123,415 into 20.5. Here also we get 25,30,000. From this we will deduct investment and add the earnings. So dear students, the investment in both the cases were of 5,50,000. So the investment in both the cases was 7,50,000 and the earnings in both the cases are 5,20,000. So this we have to deduct. And this we have to add. So this is the final value. The end of year 1. So 25 lakh 30,000 minus 7 lakh 50,000 plus 5 lakh 20,000. This will give you 23 lakhs. Here also it will come to 23 lakhs. So students, this is the value at the end of the end of the first year. Now we'll divide this by 1 plus KE. So we will get the value of the of the company. So 1 plus KE will come to 1.15. Here also 1.15. So 23 lakhs divided by 1.15 will give you the value of 20 lakhs. So dear students, you can see in both the cases whether the dividend is paid or the dividend is not paid, the value of the company comes to comes to 20 lakhs. As already told to you at the start of the question, that today's value is how much? It is 1 lakh shares multiplied by the current market price, that is 20. So today's value is also also 20 lakhs, right? So this was the question relating to relating to the dividend policy chapter. Now let us go to the next question, and it's a very good question. Similar question we have done in the in the class, but institute has made some modification in this particular question with respect to with respect to working capital, right? So let me first go through the through the entire calculations or through the entire entire reading of the of the question. Then we will understand what is the requirement, and then we will start solving the question. So what is given in the question? So PQ Limited has commenced the new business. So first of all, it is it is a new business. So in the new business, students, you know that the opening stocks will be equal to equal to 0. So opening stock of raw material 0, opening stock of WIP 0, opening stock of finished goods also 0, because it is a newly started newly started business. The following information has been ascertained for annual production of 25,000 units, which is full capacity. So we are having 25,000 units, and this 25,000 units is the full capacity. So the maximum production that can be done is for for 25,000 units. Now we are given the cost information, where the material cost is is 100, labor and variable overhead expenses are 50. Fixed manufacturing expenses are 35. Depreciation is is 15. Then we are given selling expenses, out of which 80% is variable. So 20% will be will be fixed. Okay. So what will be the bifurcation of this 10 rupees? Here the variable cost will be 8 rupees per unit, and the fixed cost will be 2 rupees per unit. So this is the bifurcation of of the selling expenses. Let us move forward. In the first 2 years of operation, so here we are given we are given in the first 2 years details we are given, and for that we are given given the production and and the sales are expected to be as follows. So in the first year, the production units are 12,000, and the number of units which are sold is how much it is 10,000. So we have we have the closing stock units in the first year to be to be 2,000, and this is the closing stock of finished goods. We are talking about the closing stock of finished goods here. In the second year, the production units are 18,000, but the number of units sold are are 19,000. So what will be the closing stock in the second year? So in the second year, we already have opening stock of how much? Of 2,000 plus 18,000 is the production done. So the number of units available for sale will be 20,000. Out of that particular 20,000, 19,000 units are sold. So the closing stock units in the second year will be 1,000 units, right? So this is giving you the details of the closing stock of finished goods. I hope you remember we have done such type of question already in the classroom. Now, the selling price is expected to be to be 250. To assess the working capital requirement, the following additional information is available. So we are having the stock of raw material, 2 months average consumption. Then we are having debtors. So this is your raw material holding period. Then we are given debtors. So this is your debtors, debtors collection period. Cash balance is 50,000. Creditors for the supply of materials is 1 month's average purchases during the year. So this particular 1 month is your creditors payment period. And expenses, all expenses will be paid 1 month in advance. So this is not outstanding, this is prepaid. All the expenses are are prepaid during the year. Then students, we are given that goods equal to 15% of the year's production in terms of physical units will be in process on the average, requiring full materials, but only 40% of the of the other expenses. So dear students, this information is about about the work in process, right? Now in this question they are telling that the work in process is is 15% of the of the production. So it is 15%, and when we'll be applying the percentage, so raw material is going to be 100% and the remaining will be will be only 40%, right? So this is a percentage of of WIP. Now students, if you remember, normally when we are calculating the calculating the raw material consumed in normal questions, what we have done in the class, in the in the class, there we have taken this particular WIP separately and we add it to the raw material consumed of the of the finished goods, and then we calculate the calculate the total raw material consumed. But here institute has not done like this. They have directly taken as taken this WIP as as 15%, and whatever raw material consumed, they have kept it only for only for the finished goods. That means they have already included, and all the calculations are done considering the number of units units produced. Now, the next information is the management is also of the opinion to make 10% margin for for contingencies on the computed figure and value the closing stock. This is an important line over here. And value the closing stock at the cost of production. Now, why this is important, dear students? This is a hint that if you want to calculate the closing stock of finished goods, you have to value it at at the current year's cost of production. So this is a hint that we will have to use first in first out method for doing the valuation of valuation of finished goods. So there is not going to be any issue in the first year. The issue will come in which year? In the second year. Now what is the requirement? We have to prepare for how many years? For 2 years. A projected statement of profit or loss ignoring taxation, and second is a projected statement of working capital requirement on cash cost basis. So dear students, this will become a lengthy question because when you calculate the profit or loss, you will have to consider consider the depreciation for the for the calculation of profit or loss. But when you are supposed to find out the projected projected working capital on the cash cost basis, in that we will be ignoring ignoring depreciation. So here we'll have to do the workings how many times? 2 times, and then we will be then we'll be finding out what is the profit or loss and what is going to be your working capital requirement, right? So we are going to first concentrate on concentrate on calculation of the profit or loss. That will act as our our working, that will help us for for preparing the working capital statement. So we will first go for for the calculation of the profit or loss. So this is our question number 7. We'll do the calculation of profit or loss together for both the years. We'll prepare one statement of statement of cost structure. I'm calculating the profit or loss together for both the years. Year 1, year 2. Calculations and amount. Now, our capital structure. Now, our statement of what profit or loss or the cost structure is going to start with raw material consumed. Let us see the details. In the first year, the number of units produced are 12,000. In the second year, the number of units produced are 18,000. Our raw material cost per unit is how much? 100. So, in the first year, it is going to be 12,000 into 100. So, 12 lakhs. Second year, 18,000 into 100. 18 lakhs. To this, we are going to add labor and variable overhead expenses, 50 rupees. Variable expenses, 12,000 into 50. 6 lakhs. Here it will be 18,000 into 50. 9 lakhs. Then the next is fixed manufacturing expenses. Dear student, this is fixed manufacturing expenses. So this is going to be multiplied with the full capacity. So it will be 25,000 into 35. So 25,000 into 35 will give you 8 lakhs. Here also same, 25,000 into 35, 8,75,000. Then dear students, to calculate the amount of amount of profit or loss, you will have to consider consider depreciation. So, to calculate the profit or loss, I am considering depreciation. But for calculating the working capital, we have to ignore the amount of amount of depreciation. Now, depreciation per unit, this is also the fixed cost for the business. So, this is also going to be multiplied by by 25. So, this will be 25,000 into, what is the depreciation per unit? We have 15. So, this will come to 3,75,000. Here also 25,000 into 15, 3,75,000. We take the total of this. This will give you factory cost. So, first year the factory cost is 12 lakhs plus 6 lakhs plus 875 plus 375. So, this will give you 30 lakhs and 50,000. Second year. This will give you 39 lakhs and 50,000. Now, dear students, to this we will add opening stock of WIP and we will deduct closing stock of WIP. Now, dear students, the opening stock of WIP will not be there in the first year. Whatever is the closing stock of WIP for the first year will become opening stock of WIP for which year? For the second year. So now our task is to calculate the stock of WIP for both the years. For this I am going to another working, that is the second one, which is calculation of stock of WIP. Now this will be year 1, year 2. So in year 1, year 2, what will be the part of the stock of WIP? So first we will take what take raw material consumed. So what will be the raw material consumed? In the question they have mentioned that the WIP percentage is how much? It is 15%. We have to take full materials, that is 100% materials, and we have to take only only 40% of the of the other expenses. So when you do the calculation of RMC for which year? For the first year. So we have to consider 12 lakhs into 15% into 100%. Here it will be 18 lakhs into 15% into 100%. So 12 lakhs into 15%, this will give you 1,80,000. And 18 lakhs into 15% will give you 2,70,000. Okay, what is going to be the second component? The second component will be labor and variable expenses. So labor and variable expenses. This will be 6 lakhs into 15% into only 40%. This will be 9 lakhs into 15% into 40%. So this will be only 36,000. And here it will be 54,000. Then we have to also consider fixed manufacturing expenses. So which is 8,75,000 into 15% into 40%. Here also same. 8,75,000 into 15% into 40%. So this will be 52,500. 52,500. Then dear students, you have to also consider what consider the depreciation. Now when we are going to consider the depreciation, that is also going to be taken as only 40%. So depreciation amount is 3,75,000 into 15% into 40%. Sir, why are we considering depreciation? Dear students, we are first calculating the profit or loss, and in calculation of the profit and loss, depreciation will be the part of the calculation. But when we will be finding out the working capital, we will ignore the amount of amount of depreciation. Here also it is going to be 3,75,000 into 15% into 40%. So this will be 22,500. Here also 22,500. So what is the WIP value? What is the work in process value? So in the first year, it will be 180 plus 36 plus 52,500 plus 22,500. It will come to 2,91,000 in the first year. Second year it will be 2,70,000 plus 54 plus 52,500 plus 22,500. So this will come to 3,99,000. So 2,91,000 and 3,99,000. So we will take this calculation in our profit and loss statement. So here it will be 2,91,000. Now this 2,91,000 is going to become what? It is going to become opening for the next year. And second year is 3,99,000. After adjusting this, we will be getting our cost of production. So this will be 30,50,000 minus 2,91,000, which will be 27,59,000. And for the second year, it will be 39,50,000 plus 2,91,000 minus 3,99,000. So it will be 38,42,000. Now, dear students, this is the cost of production. To this, we will add up opening stock of finished goods, deduct closing stock of finished goods, so that we will get cost of goods sold. So how are we going to calculate the closing stock of finished goods? So it is very simple. In the first year, the number of units produced are 12,000 and the number of units sold is how much? Number of units sold are only 10,000. So 12,000 manufactured, 10,000 sold. So 2,000 will be there in the closing stock. So this particular cost of 27,59,000 will be divided by 12,000 and this will be multiplied by 2,000. So 27,59,000 divided by 12,000 into 2,000, we will get the value as 4,59,833. This 4,59,833 is going to become the opening stock for which year? For the second year. Now in second year, how are we going to do the calculation? As I told you that we are going to use first in first out method as mentioned in the question. So here the calculation will be like this. So your 38 lakhs 42,000 is a cost of manufacturing how many units? So 18,000 units. And out of these 18,000 units, 1,000 units are left as what as a closing stock. So 38,42,000 divided by 18,000 into 1,000. So this will be 2,13,444. So now we will be able to calculate the cost of goods sold. So 27,59,000 minus 4,59,833. So this will give you 22,19,000, 99,167. The second year, it is 38,42,000 plus 459,833 minus 2,13,444. So you get 40 lakhs 88,000 389. So this is a calculation of cost of goods sold. To this we'll be adding what? Adding our selling expenses. So selling expenses variable as well as fixed. So selling expenses variable and fixed. Dear students, the selling expenses is going to be multiplied by the number of units which are what? Which are sold. So variable expenses is 8 rupees. First year 10,000 into 8, 80,000. Fixed will be multiplied by the full capacity. So 25,000 into 2, this will give you 50,000. In the second year, number of units sold are 19,000. So 19,000 into 8, 1,52,000. Fixed will be multiplied by the full capacity. So 25,000 into 2, 50,000. So now, dear students, will get the total cost. So 2299,167 plus 80 plus 50. Our total cost is 24,29,167. The second year 40,88,389 plus 1,52,000 plus 50, 42,90,389. Now, dear students, this is going to be multiplied or compared with the what? With the sales. So the number of units sold are 10,000 into 250. So this will come to 25 lakhs. And here it is going to be 19,000 multiplied by 250. So this is 47 lakhs and 50,000. So dear students, you can see in both the years, our sales are more than the what? More than the total cost, right? So we will be having what? Having profit in both the years. So in the second year, first I'll calculate the profit minus 42,90,389. So it is 4,59,611. This is a profit in the second year. First year profit is 25 lakhs minus 24,29,167. So this will be 70,833. So dear students, this is a statement of what? Statement of calculation of profit or loss for this particular question. Let us verify the answer with the institute solution. So here you can see the first, this is the profit statement. The profit or loss over here is 70,833 and what we have calculated is 70,833. Then the second year profit is 4,59,611. Here we have also calculated 4,59,611. Right? So this is a profit calculation done. Now we will go for what? For the working capital statement. Now for working capital also, dear students, I am going to prepare what? Prepare the working capital statement combined for what? For both the years. So here it will be statement of estimation of working capital on cash cost basis. Now, because it is on cash cost basis, we will have to go through the go through the modifications in the in our cost structure. Once we go through the modification of the of the cost structure, we have to take the entire cost structure, not considering not considering the depreciation. So first I'll prepare the prepare the working capital statement. Then I will prepare one more working note where I will be preparing the cost structure without considering without considering the depreciation. Okay. So let me first draw the format of the working capital. We are doing this together for both the years. Okay, I'm also preparing the working note for for the basic calculation, that is cost structure. So this is cost structure for both the years. Why do we require cost structure? A lot of calculations will come from the cost structure. So dear students, the cost structure helps us to complete the working capital statement quickly. Now, why are we preparing the cost structure again? Because we have to ignore the ignore the depreciation amount, right? So without depreciation, we have to we have to prepare the prepare the cost structure. So again, this will be okay. Now, dear students, you can look at the previous cost structure and keep on transferring the values over here. So first is going to be RMC. So I am not doing the calculation again for RMC. The raw material consumed in the first year was 12 lakh. This is not changing. It was 18 lakhs for the second year. This value is also also remaining same. Now to this we will add up what? Labor and variable expenses. This is also same, which is 6 lakhs. And this will be 9 lakhs. To this we will add up what? Fixed manufacturing expenses. So dear students, the fixed manufacturing expenses will also remain same, which is 8,75,000 for both the cases. Now we are not going to consider depreciation for the working capital calculation. So this will give you cash factory cost. So the cash factory cost, we have to take the total of this. So this will give you 26,75,000. This will give you 35,75,000. To this we will add up opening work in process and deduct closing work in process. No opening work in process for the first year. In the second year, the opening will be the closing for which year? For the first year. So, without without depreciation, what will be the opening and the closing stock of work in process? So, if you do not consider the depreciation in this calculation, with depreciation it is 2,91,000. So, without depreciation it will be 2,91,000 minus depreciation of 22,500. So, it will be 2,68,500. So, here I will consider 2,68,500 268,500 will become the opening in the second year. In the second year, what was our closing stock of the work in process? So, it is 3,99,000. From this, I will eliminate the amount of depreciation, that is 22,500. So, it comes to 3,76,500. So, that I will adjust here. 3,76,500. When I deduct this, I will be getting cash cost of production. So, for the first year, 26,75,000 minus 268,500. So, it's 24,06,500. Second year, it will be 35,75,000 plus 2,68,500 minus 376,500. So, this will be 34,67,000. To this, we will add up opening stock of finished goods, deduct closing stock of finished goods. Now, how we are going to value the closing stock of finished goods? Because in the first year, there will be no opening stock of finished goods. So, now dear students, this will be 24,06,500. This will be the cost of 12,000 units. So, how much will be for 2,000 units? So, 24,06,500 divided by 12,000 into 2,000. This will give you 4,01,083. 4,01,083. This is going to become the opening stock for which year? For the second year. Now, the second year calculation is going to be 34,67,000. This is a cost of manufacturing 18,000 units. So, how much will be for 1,000? So, 34,67,000 divided by 18,000 into 1,000. This will give you 1,92,611. So, 1,92,611. When you adjust this, you will be getting the total cost of goods sold. So 24 lakhs 6,500 minus 4 lakh 1,083. So you get 20 lakhs 5,417, and here it is going to be 34 lakh 67,000 plus 4 lakh 1,083 minus 192 611. So this will be 36 lakhs 75,472. To this we are going to add up the selling expenses. Selling expenses are variable and fixed. So variable is 80,000, 50,000. Here the variable was 1,52,000 and 50,000. So this was 10,000 into 8. And this was 19,000 into 8. Okay, so when we take the total of this, we get the total cash cost. So 20 lakh 5,417 plus 1 lakh 30. So 21 lakh 35,417. Here it will be 36 lakh 75,472 plus 1 lakh 52 plus 50. So 38 lakhs 36 lakh 75,472 plus 1 lakh 52 plus 50. So this is 38 lakh 77,472. Now this is the cost at which we are going to value our value our debtors. So this is our cost structure that is ready, and this cost structure is for calculating the working capital on cash cost basis. Okay. Now we will go for the for the working capital statement. Now in the working capital statement, I am preparing it for for both the years together. So first I am starting with current assets. First will be stock of raw materials. Now for the stock of raw material, I think we are given the holding period, that is 2 months. So in the first year it will be 12 lakhs into 2 by 12. Second year it will be 18 lakhs into 2 by 12. So here it will come to 2 lakhs. Here it will come to 3 lakhs. Second is stock of work in process. Refer working note. This we have done for for both the years on cash cost basis. So 268,500. And for the second year, it is 3,76,500. $3,76,500. Third, stock of finished goods. For this also you have to refer the working note. We have already done the valuation of finished goods. For the first year, what is the valuation of finished goods? 4,01,083. And for the second year, it was 1,92,611. Fourth calculation will be debtors. Debtors will be valued at your total cash cost. What is the debtors collection period we have? We have 1.5 months. So here our total cash cost is 21,35,417. So 21,35,417 into 1.5 by 12. So this will give you 2,66,927. For the second year, debtors will be again valued on what? On the total cash cost, which is 38,77,472. So we take 38,77,472 into 1.5 by 12. So this is 4,84,684. 4,84,684. Fifth calculation is about cash. And the cash balance is already given to us in the question, which is 50,000 for both the years. So 50,000, 50,000. Now, dear students, in this question, they are telling that the expenses are going to be paid in advance. So, we will be having prepaid expenses. Now, the expenses are paid 1 month in advance. So, the prepaid calculation will be the total of all expenses into 1 by what? 1 by 12. So, let us check what will be the expenses in the first year we will have to consider. So, first we will consider these labor and variable expenses, then fixed manufacturing expenses, then we will consider the selling expenses, which is variable as well as what? As well as fixed, right? So, let us take the total. So, total is 16 lakhs and 5,000 for the first year. 16 lakhs 5,000 into 1 by 12. So, this is 1,33,750. Let us take the total for the second year also. So, second year will be so it is 19 lakhs and 77,000 for the second year. It is paid in advance, so it is prepaid. This will be again divided by 12 here. 1,64,750. So the total will give you gross working capital. So let us take the total of the gross working capital. So the gross working capital is 13,20,260. This is for the first year. Second year total. So this is 15,68,000. 545. Now from this we are going to deduct current liabilities. First will be creditors. Now, dear students, the creditors are going to be calculated as per raw materials purchased. In the first year, it is a newly started business, so there is no opening stock of opening stock of raw material. So, the creditors will be calculated and the raw material purchase is going to be 12 lakhs consumption plus 2 lakhs of closing stock. Whatever is the total, what is the creditors payment period we have? 1 month is a creditors payment period. So, into 1 by 1 by 12. So, 14 lakhs divided by 12 will give you 1 lakh 16,667. Students, in the second year, to calculate the raw material purchases, from the raw material consumed, we will deduct the amount of opening stock and we will add up the amount of closing stock. So, in the second year, RMC is 18 lakhs minus 2 lakhs, which is opening stock, plus 3 lakhs, which is the closing stock, into 1 by 12. So, this will be 19 lakhs divided by 12. So, 1,58,333. 1,58,333. So, students, now we are not having any any other current liabilities. So, we can take the net of this. So, we will get the net working capital. So, 132260 minus 116,667. So, it is 12,03,000. $593 in the first year, then 15,68,545 minus 158,333. So, the second year working capital is 14,10,212. So, students, this was a calculation of the net working capital. Let us verify this with the calculations done by the institute. Here it is. So, it is 12,03,594. That is what they have got. We have got 12,03,593, right? So, that is 1 rupee difference. They have not deducted the 1 rupee properly here. Then it is 14,10,212 in the second year, 14,10,212 in the second year. So, this is our our working capital calculation. Now, to this we have to add up add up the 10% contingency margin. So, this 10% will be added over here. This 10% will be added over here. So, the final working capital is going to be 13,23,953 for for the first year, and 15,51,233 for which year? For the second year. So, this was a very good question, and with lot of modifications. We have done the similar question in in the class, but here they have introduced introduced the work in process. Also, they have asked you to do the calculation of working capital on the cash cost basis. So, dear students, now we are left out with with one last small discussion. So, the last question is the theoretical question, where they have asked you a basic understanding of explaining the difference between the wealth maximization objective and why it is superior to to the profit maximization objective. So, dear students, you already know that wealth maximization objective is is preferred for for financial management, because of because of various reasons, because shareholders are interested in what, in wealth, which is nothing but the cash which is going to be generated from what, from any project. So wealth maximization is more powerful because of what, because of time value of money, because of the actual what, actual cash that is going to be considered in comparison to what, to the profit maximization, where the more focus is on what, on accounting profit, right? So these are the reasons why wealth maximization is what, superior to the profit maximization. So the institute has given the what, given the theory. So we can go through the what, go through the theory, and there we can consider what, consider why wealth maximization is what, is more powerful than the what, than the profit maximization. And the last question is, we have to explain the importance of the trade credit and accrual. So trade credit means creditors and accruals means some outstanding expenses as a source of working capital. What is the cost of these sources? Now, dear students, as you know that the current liabilities, the role of the current liability is to give us a relief from the money which is going to be blocked in the business, and therefore the trade credit and the accruals are what, are important for reducing the requirement of what, requirement of the money to be blocked in the business. And this will not come free of cost. This is not going to come free of cost. There is going to be cost involved in terms of what, in terms of interest, right? These are the two what, two theoretical questions. So dear students, this was the entire analysis of what, of your RTP for May 2024 examination. Thank you very much.